A typical rental house in a city like Charlotte or Tampa rents for somewhere around $2,600 a month right now. Run the numbers on a property like that, and it usually clears a cap rate somewhere in the 4 to 6% range annually, which sounds like it should mean landlords are hauling in serious money every single month. Except once you actually subtract the mortgage, the property tax, the insurance, and the inevitable repairs, that same $2,600 often leaves the landlord holding somewhere between $150 and $350 in genuine cash at the end of the month. Some months it's less than that. Small landlords, the ones who own 1 or 2 properties rather than a few hundred, routinely report cash-on-cash returns somewhere in the 1 to 4% range annually, which means putting $50,000 down on a property might net you $500 to $2,000 a year in actual spendable cash. You could get a comparable return sitting in a savings account, and a savings account has never once called you at midnight about a broken water heater. So how do landlords actually build real wealth doing this? Let's follow the money from the check you write every month to the fortune landlords actually walk away with, because it turns out those are two almost entirely unrelated things. The obvious answer is the one everyone reaches for first, and it isn't wrong exactly, it's just incomplete. The rent check is real money, paid in full, and it does cover real costs. Before anyone can call it profit, that check has to survive the mortgage interest, which eats the largest slice in the early years of any 30-year loan. Then property tax, which climbs almost automatically as a home's assessed value rises. Then insurance, which has genuinely spiked in a lot of states recently. And finally routine maintenance, since a failing water heater has no interest in whether this happened to be a good month financially. Add those 4 together against a typical rent check, and there usually isn't much left standing, and in a rough month there can be nothing left at all. If the rent check itself were the whole business, and small landlords really are only clearing a point or two of actual return a year on it, a landlord chasing nothing but that number would be one of the worst investors in the country. So if the visible number on the lease isn't where the real money lives, something else has to be happening quietly underneath it, something that never shows up on a rent receipt and never gets mentioned to the tenant writing the check. Start with what's sitting directly beneath that rent payment, because this layer is the one you can actually see if you compare 2 numbers side by side. Picture a house purchased 8 years ago for $300,000, 20% down, financed with a standard 30-year fixed mortgage. The full monthly payment, principal, interest, tax, and insurance combined, landed somewhere around $1,700, and here's the part that matters most about it. That number was locked in permanently the day the loan closed. Not roughly fixed, actually fixed. Interest rates can climb, inflation can run hot, and that specific payment simply does not move. Rent doesn't work that way at all. That same house might have rented for around $1,900 a month back when it was purchased, barely above the mortgage payment, which would have felt like a thin, barely there margin at the time. But rent tracks the local market year after year, rising a little with each new lease, and a little more at every renewal. And 8 or 9 years later, that identical house is commonly renting for $2,500 a month or more depending on the city. The mortgage is still $1,700. Subtract the 2, and you get roughly $800 a month that simply didn't exist when the lease began, multiplying out to nearly $10,000 a year, landing in the landlord's pocket, purely from that widening gap, and it keeps growing every year, without the landlord doing anything differently at all, because one side of that equation is frozen solid, while the other keeps climbing with the market. The tenant only ever experiences their own half of that ledger, watching their rent climb from $1,900 toward $2,500, and reasonably assuming that's simply the cost of living. What they never see is the other document sitting in a filing cabinet somewhere, the one showing the landlord's fixed cost hasn't moved since the year the loan closed. That widening spread is only the first layer, and it's the one you can actually spot by comparing 2 numbers. The second layer doesn't even register as cash flow at all. It's happening silently inside that same monthly mortgage payment. That $1,700 payment isn't a single thing, it's really two completely different payments stapled together. One portion is interest, the bank's fee for lending the money, and that part is simply gone forever. The other portion is principal, and principal doesn't vanish, it converts directly into ownership the landlord could sell tomorrow. On a typical loan in this range, something in the neighborhood of $500 to $600 of that monthly payment chips directly away at the loan balance every single month. And critically, that money isn't coming out of the landlord's own pocket, it's arriving inside the tenant's rent check. Stretch that mechanism across the full life of a 30-year mortgage, where the principal portion of a fixed payment mathematically grows larger every year, even though the total payment never changes, and a landlord who put down a modest fraction of a property's price eventually ends up with the entire original loan paid off in full, not through their own salary, but through 3 decades of tenants making that payment for them one rent check at a time. None of this ever shows up on a lease. There's no line item reading principal paydown contribution. The tenant writes one number, watches it get labeled rent, and never sees the internal breakdown where a growing slice of that same payment quietly becomes someone else's home equity. There's a third pile of money in this entire system, and it has nothing to do with the loan or the rent check at all. It's simply the house itself becoming more valuable while nobody does anything to it. Nationally, home values have historically climbed somewhere in the 3 to 5% range annually over long stretches, a number that sounds modest until you let a full decade pass. That same $300,000 property, doing absolutely nothing but sitting there, can realistically be worth somewhere around $450,000 a decade later, sometimes considerably more, in a genuinely hot market, representing $150,000 or more in value that appeared while the landlord did essentially nothing. And critically, none of that gain is taxed while the landlord still owns the property, since the IRS treats it as an unrealized gain, real on paper, but frozen until a sale actually happens, or until the landlord uses a specific, widely underused tool called a cash-out refinance. The mechanism is straightforward. The bank values the house at its current market price rather than its original purchase price, calculates the equity sitting between that new value and the remaining loan balance, and lets the landlord refinance into a larger loan, with the difference paid out directly in cash. No sale occurred, no capital gains taxes owed, because in the eyes of the IRS, a refinance is simply a new loan, and loans are never counted as taxable income. The landlord walks away with a genuine 6-figure cash payout, still owns the house, still collects the same rent, and none of that appreciation ever touched anything the tenant paid that year. Underneath all 3 of those layers sits a fourth one, and it's arguably the most powerful of all. Sitting entirely on a tax return almost nobody outside real estate has ever actually read. It's called depreciation, and the government essentially hands it to landlords for free. The IRS treats a residential rental building as though it wears out completely over 27.5 years, letting the owner deduct that fraction of the building's value from their taxable income every single year for nearly 3 decades, regardless of what the property is actually doing in the real market. On a typical rental property where the building itself, excluding the land, is worth somewhere around $200,000, that works out to roughly $7,000 to $8,000 a year, the landlord can subtract from taxable rental income, even while the property is simultaneously climbing in real market value. Both things are true to the government at the exact same time, rising in the marketplace and depreciating on the tax return. For a landlord in a moderate federal tax bracket, that single deduction can shelter somewhere around $2,000 a year in taxes that would otherwise be owed, and stacked against the rent spread and the equity paydown happening simultaneously, a property that's genuinely cash flow positive can still show the IRS an on-paper loss for the year. For landlords who qualify for real estate professional status, a designation requiring a substantial number of hours actively working in real estate, those paper losses stop being confined to real estate income entirely and can offset a salary, a business, or investment gains from anywhere else in their financial life. So what actually eats into this machine in the real world? Property taxes climb with reassessments, sometimes sharply after a sale or a hot market cycle. Insurance has become genuinely brutal in a lot of states recently, with premiums in hurricane-exposed and wildfire-exposed regions climbing by double-digit percentages in a single year, enough on its own to wipe out a landlord's entire monthly cash flow margin. Maintenance reserves, commonly budgeted around 1% of a property's value annually, sit waiting to be spent on a roof or an HVAC system that always seems to fail at the least convenient moment. Vacancy between tenants earns nothing, while every fixed cost keeps arriving anyway. And property management fees, commonly 8 to 10% of collected rent, for landlords who'd rather not answer a midnight call about a burst pipe, quietly shave a real chunk off the top before the landlord ever sees a dollar. Stack all of that together, and a healthy-looking rent check can shrink dramatically once every real cost is honestly subtracted, which is exactly what happened to a wave of small landlords in insurance-stressed states over the past few years, watching a comfortable monthly margin evaporate entirely even though the tenant's rent never changed and the mortgage never moved. And this is precisely why the whole arrangement is so difficult to compete with or knock over. A landlord who put down a modest fraction of a property's price controls an asset worth several times what they personally paid for it, meaning ordinary market appreciation applies to the full purchase price, not just their own cash investment, turning a normal single-digit market gain into a dramatically higher return on the landlord's actual out-of-pocket capital. And the debt underlying that entire structure isn't really being serviced by the landlord month to month at all. It's being serviced by the tenant's rent. Compare that to almost any ordinary small business, where a bad month simply means less revenue, with nothing underneath it, quietly appreciating in the background. A landlord's bad month looks completely different, because even while cash flow goes negative for a stretch, the underlying asset is still standing, still roughly as valuable as before, and the loan balance is still shrinking regardless of how the month actually went. And this entire machine scales in ways that make individual landlords look almost like a rounding error. Companies like Invitation Homes and Progress Residential each control tens of thousands of single-family rental houses nationally, with American Homes 4 Rent and a handful of other institutional operators holding similarly enormous portfolios, running the exact same 4 layers: the fixed mortgage against rising rent, the tenant-funded principal paydown, the quiet appreciation, and the depreciation shelter, just at a scale with dedicated finance teams refinancing thousands of loans the moment conditions turn favorable, and tax teams stacking depreciation schedules across an entire portfolio at once. So the next time a rent payment goes out to a property management company with a corporate name attached, understand what's actually happening underneath that transaction. The rent check was never really the profit. It was simply the fuel that kept a much larger machine running quietly in the background, one that was never really about the number written on the lease at all.